content. So good evening again and welcome everyone to what I personally believe will be a very exciting session. So financial reporting has undergone a fundamental shift in the last decade at least. So IFRS is no longer viewed solely as a framework for compliance and disclosure. Global standards are now shaping how organizations communicate performance, assess risk, evaluate value, and even support strategic decision making, most importantly. So accountants and finance professionals are no longer perceived as maybe bookkeepers, number crunchers, whatever the prehistoric perception was. They have become storytellers of a company's performance, history, and future. So some of the questions that shape these stories, which probably many of you have previously asked, are currently asking, or have answered at some point: how should organizations interpret revenue recognition in what is now an increasingly complex commercial arrangement? So how early should risk be reflected in financial reporting? What do balance sheet transparency and fair value measurement really tell stakeholders about business health, future performance? And as reporting standards continue to evolve, particularly with the introduction of IFRS 18, which is going to be implemented in 2027, how can finance teams prepare to deliver more meaningful and, most importantly, decision useful financial information? So by exploring these topics today, our objective is for you to be able to walk away with a broader strategic perspective on the role of IFRS in modern financial leadership. Maybe more practical insight into how key standards impact financial performance, reporting quality, and stakeholder communications. So definitely we aim for you to have a deeper understanding of the business implications behind standards maybe like IFRS 15, 9, 16, IAS 36, and many others. And definitely, we hope to give you greater readiness for future direction of financial reporting and evolving stakeholder expectations. So I would like to kindly point your attention to a very short 5-question poll that will give us a perspective on your perspective and experience around the evolving role in IFRS in your current organization or in general organizations. It will be open throughout the whole session. So whenever you feel good and ready to take the time, we'll appreciate if you could answer the questions as well. So to lead this discussion today, I am personally delighted to welcome Mr. Khattar Nasr. Khattar is an executive MBA holder, DipIFR certified finance leader, IFRS expert, and one of Morgan's distinguished Diploma in IFRS alumni as well. Notably, he stood out by achieving an exceptionally high score in his DipIFR exam, an achievement that reflects both definitely exceptional technical mastery and professional excellence, which is the reason why today Khattar continues to contribute to the development of finance professionals by teaching the Diploma in IFRS program with Morgan International as well, combining his strong academic expertise with practical business insight and real-world expectations. I'm going to give Khattar a moment in just a few moments to introduce himself. But first, Khattar, before you dive into all the standard subject of this session, as someone who has worked extensively, I would say, with IFRS, both in practice and in training finance professionals, what is your personal take on the importance of proper adoption of IFRS? I mean, most accountants, all finance professionals probably know, have heard of IFRS. Maybe not many adopt them in full. So how do you feel about it? But not only from a compliance standpoint, also in terms of transparency, decision-making, and most importantly, building stakeholder confidence.
Right. Thank you, Charles, for the intro. So as Charles mentioned, my name is Khattar Nasr, and I have 20 years of experience when it comes to finance. I'm a regional finance director and obviously a holder of the Diploma in International Financial Reporting. I mean, the question sits exactly at the heart of everything we will cover tonight. For me personally, early in my career, I approached IFRS the way most of us are trained to, right? So as a set of rules to comply with. And this is not the juicy part about it. So get the journal's entries right, pass the audit and move on. But the turning point for me both in practice and in training, was realizing that every standard tells a story, and it really does, as we're going to see tonight, about the economic reality of a business. So, for instance, when you apply IFRS 15 correctly, you are not just recognizing revenue at the right time, you are telling management and investors when value was genuinely created. When you build an ECL, so speaking about IFRS 9, you are not just provisioning, you are giving your CFO a forward-looking risk signal before the damage is done. Now, just to set expectations, we're going to talk a lot technical here tonight. Again, the shift from compliance to communication, that's what I'm going to focus on, is where IFRS becomes genuinely powerful. So this is what we're going to tackle tonight, Charles.
Amazing. Amazing. Thank you so much, Khattar, for taking the time to be with us on this tonight. I hope everybody will enjoy what I really think is going to be very exciting for everyone. And the platform is all yours.
My pleasure. Thank you. I will share my screen. All right. So, good evening again. So over the next 45 to 50 minutes, we are going to do something a little different with IFRS. We are not going to memorize rules, so no rules memorizing for the night. I hope I didn't spoil this to anyone. We are going to use them, all right? So I'm gonna go to the agenda. We're gonna look at 7 standards with the most exciting one being IFRS 18, which is gonna come, as Charles mentioned, in 2027. So we're gonna look at IFRS 15, when a sale is not a sale. IFRS 9, provide for risk before it happens. So again, forward-looking, as I mentioned in my reply to the question. IFRS 16, hidden debt, however, a visible impact. IAS 36, is the asset worth what the book says or something else? IAS 37, tomorrow's cost, booked today and measured today. IFRS 13, what's the asset worth? So fair value measurement. And IFRS 18. Okay, so the standards that we're gonna approach at a glance, a bit of history. Before we move to them and check them one by one, I want you to notice something, that standards on the left of this side. So IAS 18 was replaced by, IAS 18 was replaced by IFRS 15. So what we know today as revenue was initially, as you can see here, it was IAS 18 and IAS 11. IAS 39 was replaced by IFRS 9. So the term or the acronyms IAS are moving all towards IFRS, continuing with IAS 17, which was replaced by IFRS 16, and most recent IAS 1 is being replaced by IFRS 18. Now, what's the pattern here? What am I trying to say? Every single replacement moved in the same direction. So from rules that allowed management to delay recognition of economic reality to standards that demand you to recognize it earlier, right? So earlier recognition. IFRS is consistently tightening. It is consistently moving towards transparency. And that is the context for everything we are going to discuss tonight. Right, starting with one of my favorites, and in fact, all of them are very nice standards. So IFRS 15, revenue, when a sale is not a sale, and let me show you what I mean. So a question before I delve into this slide. So has anyone in this room or in their company ever had a sales director send a message saying we hit a revenue target while finance was still debating whether the revenue was actually recognizable? That tension is exactly what IFRS 15 was written to resolve. So I'm going to walk you through first the theoretical part or the comprehensive part. What are the 5-step revenue models? So first of all, without these 5 steps, you cannot recognize revenue. So first of all, we're talking about identify the contract with the customer. So there should be a contract. Second, identify each separate performance obligation. So what we're going to see in the example that there might be several performance obligations that are involved, and this does not mean that revenue can be recognized for both of them at the same time. The third one is determine the transaction price. So there should be a transaction price, and the price should be allocated to each obligation, and we're gonna again see how in the example. Eventually, recognize revenue, and this is very important when control transfers. So control is always at the heart of the international financial reporting standards across all the standards. Okay, so control is very important. Now that I've walked you through the theory part, let's see how this translates into business partnering. Okay, so I gave an example here where a software company sold a bundled deal. Bundled deal means a combined deal. So there is a sale, a performance obligation, as I mentioned, which is a license. So we should deliver, as the seller, we should deliver a license, and separately 12 months of support. So as you can see, there are two components here. Software license, which has a standalone price of 90,000. So if you look what I'm doing in the breakdown, I'm trying to apply the 5-step model, right? So first of all, there is a contract. Second, there are two separate performance obligations. And third, we are determining the transaction price. So again, the allocation is 75% to the license, which is the bulk. So 90,000 US dollars should be recognized as revenue upon delivery of the license. So when control is transferred, and the 12-month support, guess what? You can only recognize 2.5 thousand or 2,500 a month because there is a deferred income part which goes to the balance sheet, since you will be simultaneously delivering the support, and thus control is transferred simultaneously and not immediately. Okay? So this is one. What's the business partner insight here? So as we said, month one should be $90,000 revenue, not $120,000. The 30,000 difference is not just an accounting adjustment. It affects the P&L reporting, management bonuses, bank covenants, and investor perception. So what I'm trying to say, it's not 120,000 as revenue. It's instead 90,000, 92,500 of revenue as month number one. So finance, you guys, the finance people, finance must be in the room when sales are structuring deals. We're not here to clean afterwards, right? We are the storytellers and we are business partners. That's the first standard knockdown for today's session. Again, the standard is much more bigger and it requires a lot of hours to explain. But again, we're trying here to prove a point and to see how we're moving from compliance to communication, since finance people are no longer are no longer numbers cruncher, they are business partners. IFRS 9, so expected credit loss. Expected credit loss is just part of the standard. Okay, so how we provide for risk, listen very carefully before it happens. So we need to be forward looking, okay? The standard that says do not wait. So the standard that says do not wait for your customer to default, recognize the risk today. Okay, so what's the story here? My structure for the presentation is always the theory. The theoretical part will be on the left, and on the right, we're gonna do the example. Okay, so under IAS 39, which was the old standard, as I mentioned, you needed objective evidence that a customer had defaulted before you could book a loss. So we could not book a loss before there has been an evidence. You were watching. So back then, you were watching someone walking towards a cliff and waiting for them to fall before you acted. That was IAS 39. And this is why we have the IFRS 9, where it says, see the cliff, act now. So you're going to raise the flag before it happens or before you fall, if we're looking at the example of the cliff. Again, for IFRS 9, specifically, again, the expected loss, there are 3 stages. Okay, there is, first of all, at the beginning, of a receivable registration or booking, there is a 12 months expected credit loss. So this is the standard day one provision. And we're going to see it in more details in the example. Stage two, when the risk is bigger, you should account for a lifetime expected credit loss where there is a significant deterioration in credit worthiness, which means more risk for the customer to pay you your receivables. Stage three, which is credit impaired, lifetime ECL, where the customer is not likely to repay. So active management is required to be able to understand what should we do with the ledger. Is it a write-off? Should we go legal, etc.? Use all the tools that we can do to ensure that we collect our money and we present fairly our financial statements. Now I'm gonna go to the example. It's gonna make our life much more easier. Dealing with numbers, always do that. So what's the example? We're saying that we have trade receivables, so AR or accounts receivables of $1 million as a balance on our balance sheet. How is this split? As you can see, there are aging buckets, so 0 to 30 days, 31 to 60, 61 to 90, and 90 plus. What are the balances that make up the 1 million, 500 million, 250, 150, 100? So the current bracket, which is 030, has the biggest value, while the 90 plus days is the smallest value. However, as you can see, the default or the assigned expected risk would be the lowest on the most recent one. And you will ask me, Khattar, why? But those are recent. This is what the standards say. You need to be forward-looking and you need to assign a risk based on the age of the debt for the entire ledger. So 1%, 3%, 8%, and look at the 25%. Based on a weighted average, this is around 5% of your ledger, which you should book today as an expected credit loss allowance. It used to be called provision for bad debt, but it is called expected credit loss allowance. It will hit your P&L. Again, and here's the thing, this is why this topic is also with the finance team. The finance team should not it should not say that it's a collection or a credit control issue. No, it is impacting your P&L by increasing your cost. So if the risk increase, imagine if the balance for the above 90 days was more than 100,000, this means that you have to book more expenses. Hence, you should not let the receivable slip. Payment should be made on time as much as possible. Right? And this is the flag that we've spoken about in terms of raising it to your CFO. Two standards down, I'm seeing some questions and some raised hands. Unfortunately, the time doesn't help me. If I finish earlier, I will try to look at those and pick them up, but Charles is also collecting the questions as we move. Right, so we move to IFRS 16, leases. Okay, so when we say IFRS 16 leases, that's the number of the standard and the name of the standard. So hidden debt now visible. What do we mean by hidden debt now visible? We're going to talk about it. So if your company signs leases, and I'm sure the majority of the companies does, leases are rent. So when you rent a certain, be it vehicle, be it office, be it any equipment that you might be leasing, IFRS 16 has some conditions which might require you to recognize them under the standards. Okay, same structure. So theory, example. When IFRS 16 came in, the retail sector added hundreds of billions to their balance sheets overnight. So imagine the change that came with the standard. Okay, so stores, warehouses, delivery vehicles, all previously invisible because we used to say it's an operating lease. I can go and just book a rent in my P&L. So suddenly now we have assets and liabilities to deal with. Some companies, given that change, breached their debt covenants. Not because the business changed, but because the accounting finally showed what was already there. Okay, so we know for a fact that IFRS 16 is the right thing to do and no longer IAS 17. So what was IAS 17? IAS 17 was called operating lease. So there was nothing on the balance sheet, as I mentioned a couple of minutes ago. There was only a rent expense on your P&L, no debt appearing, and of course, the EBIT included the rent expense, as I mentioned. Now, the huge transition to IFRS 16, all the leases now are showing on the balance sheet. So you have something called right of use asset or ROU asset, and you have a lease liability. So in your assets, you have an asset, and in your liabilities, you have a debt. Okay, and how is that calculated? We're gonna see it, or how is that determined? Okay, the rent expense has been split into two. Since now I have an asset and a liability, I have a depreciation expense and I have an interest expense related to the liability. This will improve the EBIT. Guess what? Guess why? Because the interest expense we know in the EBIT is shown below that line. So we're saving here in terms of cosmetics, of course, I'm speaking about, or reclassification for the P&L, we're saving and the EBIT is looking much higher. Now, if I go for the example, what do we have here in the example? We have an office of for a period of 3 years with a rent or a lease amount of 24,000 per year and a discount rate of 6%. Here, of course, we have to include something that we call the discount rate because those 3 years rent are not for this year itself. That is 24 this year, 24 the coming year, and 24 after 2 years. Those amounts should be clubbed and discounted based on the amortized cost model to get today's value on the balance sheet. How is that done? So, as I mentioned, the initial liability is 24,000 multiplied by the annuity value to consider the 3 years. This means that your liability today is not 24,000 multiplied by 3, it's 64,152, as you can see it under year one, under opening liability. Okay, I have an interest to pay and I have a payment to make, which makes my closing balance $44,000. The closing balance is my opening balance for the coming year, and so on and so forth. As you can see, the closing balance on year 3, when I pay the third payment, will become as 0. Now, there's a lot of numbers here. What are we trying to say in terms of business partnering? So here, you should also be in the room. You should also be consultant, because before the business signs any lease, a new office, a warehouse, a vehicle fleet, finance should be at the table again, as we mentioned, to model the full impact. So you need to model the full impact to understand what's the impact on the dynamics of your financial statements. So what does this add to net debt? Does it breach any covenant? Because if you have loans with banks, you have certain covenants that you need to be compliant with. So would this change anything in that aspect? Or potentially, is it better to buy? So there is this trade-off that you need to decide upon, of course, after running the numbers. And those are the strategic questions that you should be dealing with. I'm going to move now to IAS 36. So those are a couple of standards now we're going to see. As you can see, they are still named IAS 36 because there has been some adjustment, but they have not changed completely like we've seen in IFRS 15, in IFRS 9, and in IFRS 16. Here, I want to ask a simple question. Is the asset on your balance sheet actually worth what the book value says or what the carrying amount says? Let's find out. Okay, so I mean, the question here also to ask is, has the company ever written down an asset significantly at year end? So when you arrive on December, you immediately discover that there is a write down of the value of the asset, which will create a surprise and will not manage the expectation of the management. If yes, in my opinion, this is a failure for us as a finance business partner role, right? Because impairment, so again, the standard talks about impairment. Impairment should never be a surprise. It should be a conversation starting earlier throughout the whole years. For instance, for the company I work for, we do have a policy and we do have a certain timeline and the discussion related to those timelines each year, same time, where we go and start our impairment exercise. So what is this impairment thing? Let's go a little bit to the theory or what the standard says. So the most important piece here is that an asset on your balance sheet cannot be carried above its recoverable amount. What does recoverable amount means? Recoverable amount is the higher of two things or two values. So it's the higher of the fair value less cost to sell. So if you're selling this asset and it has a certain cost incurred to it, you should check the fair value and deduct from it the cost to sell versus the value in use. So which one is higher? This is the new carrying amount of the asset, like we're going to see now in the example. The value in use is usually calculated based on a discounted cash flow model. But what could be a trigger to impairment؟ يعني شو ممكن يجبر الشركة تنزل الفاليو تبع الأصول أو الأسيتس تبعها. It could be declines in revenue. So revenue ممكن يكونوا عم ينزلوا, hence the value of the business is no longer the same. Okay, it could be a market downturn, so markets نزلوا due to anything. It could be that the asset is becoming obsolete, okay? Or we do have some restructuring plans and the asset will not give the same value. The market capitalization, if the business is publicly listed, it could be that the market capitalization of the net assets is falling. Hence, you should flag the impairment or the potential impairment before the audit exercise starts. Okay, so this is the strategic drive that I need everyone to think about, or the IFRS gives you. Okay, so again, we've spoken about the core test of impairment. Let's go to the example. The standard itself speaks about something called cash generating unit. Cash generating unit is simply a group of assets that generates cash together, like let's say, a business, a company, which cannot generate cash only from the building available. It needs the building, it needs the equipment, it needs the employees, and it needs other elements. So this is what we call a cash generating unit. So assuming this cash generating unit on my assets has a carrying amount or a book value of $2 million. I need to check if there is, or I need to make an impairment test. That's the right technical word to use. I need to make an impairment test. To do that, I need to check two values: fair value less cost to sell, which is here, for example, purposes 1.6 million. And on the other hand, I need to check the value in use, which is the discounted cash flow, value of the future cash flows. We're saying here that it's 1.750. Of course, we're going to go for the recoverable amount, which is the higher of. And here it would be the 1.7 million. 1,750,000. Okay, so I pick up this number and I compare it to my carrying amount. We're saying that it's lower by 250,000. And that's the impairment loss that should be booked for this asset specifically. Okay? Now, this means that the asset value will be on the balance sheet 1,750,000, and we're going to also incur a loss in our statement of profit and loss and other comprehensive income. What's your role here? What's the business partnering role here? What's the business partner should here, or the finance should come and try to discuss with the management any potential increase, let's say, or improvement in margins. So if this cash generating unit can improve its margins, the value in use or the discounted cash flow of future, discounted value of future cash flow might be higher than 1,750. Okay, so imagine any change in the percentage might drive the value near the 2 million or even higher than the 2 million. And at that point, you would either avoid an impairment loss or you could have a revaluation surplus, for instance. Again, a conversation, not only numbers crunching. Moving to another standard, or the fifth standard we have today, IAS 37. So provisions. I added here recognizing tomorrow's costs today. Okay, so this is the prudent approach we are trying to apply here, because part of the IFRS is the conceptual framework, which always relies on prudence, not overly prudent, but to be properly proven with proper science behind it. So provisions are where accounting judgments meet business reality most directly, right? So provisions are always, as I mentioned earlier, estimates or accounting judgments. And the risk runs in both directions. So the risk runs in, be it up or adverse. Okay, so adverse means down. Under provisioning, so understating the provisions might overstate your profit because you're booking a smaller expense. So you cannot under provision the correct amount of provisions. And it gives also the management a false sense of security. So imagine you have a big provision that you should have provided for, and you've not. The management will look at the numbers and will have a false sense of security. Over provisioning, if you're even increasing more your provisions, it could be considered as smoothing your earnings. Why smoothing your earnings? You might be increasing those this year for the sake of releasing them in a coming year. And as such, in the coming year, you might be able to attract bonus. But again, it's not for the right reason, not for the right reason, or for this year's performance, because it's coming from a prior year. Both are wrong. So as I mentioned, be it underprovided or overprovided for provisions is something wrong, and we would not be playing our role as business partners. To start with the theory or with the theoretical part, when must we recognize the provision? So there are conditions. All the standards have conditions that you will go through once you opt for the diploma or for the curriculum. So one, there should be a present obligation. يعني علي انا واجب، علي liability اليوم. اوكي، ممكن ما اكون بعرف قد ايه هي بالضبط. اوكي، هلا حنشوف steps يلي جايين. So again, present obligation, there are two types usually, legal or constructive. اوكي، legal اذا هي جايه من a certain legal requirement. constructive هي اذا let's say نحن نعطي rebates على على مكانات او على برودكت بعناه وبيكون malfunctioning، هيدي بنسميها constructive، لانه بنكون حطينا liability كمان على حالنا وقلنا للزبون انه in case of defect you can return it or you can get a certain discount. So one قلنا present obligation arising from a past event، كتير مهمة هيدي. So بيكون عندنا present obligation arising from something that happened in the past. It is probable that economic benefits will be required to settle it. So again, this liability or this cost, there should be a settlement. There should be an economic impact on me to be able to book it. That's the second condition. Third, a reliable estimate. So look closely here what we're saying, a reliable estimate. Okay, so judgment is very important, and supporting science behind the estimation of this is also very important. What are the common examples? Product warranties, legal claims and litigations. I just mentioned them more explicitly while I was explaining it. And decommissioning obligations. Decommissioning obligations are usually related to construction projects where, let's say, you are constructing or building a certain plant and you agreed in the contract or agreement initially that you're gonna remove everything that might impact the nature or sustainability, etc. So this means that you have additional costs to spend, and you have also to make a certain, a reliable estimate for this decommissioning cost. Again, I know it's too much data to handle, but again, for the sake of the time, I've tried to summarize it as much as possible. And I gave here one example, the warranty provision. Okay, so I selected the warranty provision. What is the example here? It's also a simple one. So 10,000 units. We have a business where we sell units. We've sold 10,000 units. 5% are expected as a fault rate. Okay, so based on my historical operation, I know that 5% out of my sold items are usually defected, okay, or default. I have an $80 cost average of repair. So هول 5% كل وحده حتكلفني منهم $80. شو مفروض نعمل هون؟ So the transaction is that I should immediately, when I sold those items and recognized revenue, I should match them with a warranty expense. The warranty expense is 5% multiplied by 10,000, okay, multiplied by 80. All right, so I should debit my warranty expense, I should credit my warranty provision in the liability on the financial position or the balance sheet. Okay. However, this 40% extends for more than 1 year. What I have to do is that I have to actually claim only the cost related to the year itself, which is 15,000, and the remaining 25,000 will remain as an exposure on my balance sheet. So what happened here? What happened is that the customers actually claimed 15,000 of the 40,000 that I estimated. Okay? But knowing that I'm still expecting an exposure because the 5% is not fulfilled yet, I will keep this remaining exposure at the end of the year on my balance sheet, and I will revise it in the coming year if the estimates or the judgment changes. Okay? Again, as you can see, there's a lot of judgment, there's a lot of element, and plenty of communication. But the most important thing is to have your supporting available and to have the science behind every item on your financial statement. Moving on to the IFRS 13. So fair value. What is the asset really worth? This standard specifically speaks about how International Financial Reporting Standards requires businesses or entities to assess the fair value of their assets. So historical cost, again, tells you what you paid for this asset. Fair value will tell me what is the asset worth now. So again, in the eyes of the market participant, the standard says market participant several times. Market participants in البيع والشراء, so buyer and seller, the parties involved in the transaction. So the historical cost and what the asset is worth now, or the fair value, are two completely different figures. They are often different. I'm going to start with what the standard says in terms of how do we calculate the fair value. It's usually 3 levels, okay? And the more the level increases, the more the involvement of us, the business partners or the finance people. So there is something that's called exit price, the sale price. So whenever you have a fair value, you can probably sell the asset, or you think you can sell the asset using this value. Level 1 is quoted prices in active markets. And this is usually for quoted businesses or for publicly listed businesses, such as Apple, such as Microsoft, such as Citibank, and the list go on. Okay, so those are very easy. I go now and check what's the stock value on the stock exchange, and I can sell or buy. Level 2, which is a bit more challenging, of observable inputs. So similar asset prices. عندنا بالريجن شوي صعبة, specifically بلبنان. However, outside there are websites and sources that tell you that, let's say, if you own a hotel and you want to assess its value today to get the fair value, there are several hotels, let's say in Saudi Arabia or in Europe, that have been sold lately. What you can go is that you can go and check those similar assets in the industry itself, and you can benchmark the fair value to it. Okay, if there are 5 or 7, you can take them and make the average. There are also other methodologies to do it, but this is basically the core concept of level 2, or the observable inputs. Level 3, my favorite, is when you don't have level 1 and level 2. Hence, you have to make projections. So you have to make projections for your full financial statements. And this means that you have to arrive to your cash flow and discount those cash flows to today. And this is where judgment is required again. Okay. So as I mentioned in the beginning, the higher the level, so if you move to level 3, the more judgment is involved. And honestly, it's harder for us because we have to defend whatever we are presenting or whatever we are uh, projecting. For the example, I'm going to assume that there are no comparable sales available. So I don't have, it's not a quoted business, so I don't have level one. And there are no similar asset prices. I have to move to level three. Okay, so level three, I have to make evaluation. I will not go into the details of the valuation, but I have an investment property that I'm renting or I'm getting, receiving income from the lease. Okay. The fair value is usually the lease value divided by the discount rate, which is here 8% for the sake of the example. This means that this investment property's fair value, in my opinion, is 1.5 million. Okay. So again, 120,000 divided by 8%, the fair value is 1.5 million. The book value of this investment property on the balance sheet as of today, let's say, or after the cutoff period, is 1.2 million. This means that you can recognize a 300 million revaluation gain. So 1.5 million minus 1.2 million, the assets you own and it generates income and earnings for you is booked at a lower value than its fair value. All right. Again, this is all part of the business partnering. And the most important thing is that you should be able to defend the 8%, which is not subject to our discussion tonight or even the IFRS, but there are ways to calculate the discount rate. And feel free to reach out to me or ask those questions anytime. And again, any percentage change, if you can see here in the blue box, I've added it. So a 1% change can move the value up or down by 150,000 up to 200,000. Okay. So we usually use a technique that we call stress testing or scenario analysis. So I use the 8%. I can use also 7%. I can use also 9%. Okay. You can even do 5 scenarios just to understand what the numbers mean. Okay. So this is IFRS 13 fair value. Moving on to IFRS 18. And this is the newest standard, which is applicable as of January 2027, not for small and medium entities, not for the entities that are not publicly listed, but again, anyone can choose to adopt the standard. So any business can choose to adopt it, but publicly listed entities have to abide and have to comply by 1/1/2027. Okay, I'm gonna cover it briefly, but I can tell you that we are personally looking at it and to apply it because we are a publicly listed entity available in many continents. And again, we report to the market, so we do have to do it. What's the core change? So first of all, as I mentioned in the beginning, IFRS 18 replaces IAS 1. It restructures mainly the income statement into 5 mandatory categories. واللي منكم بيعرف, for the people who know the cash flow, it's similar to the cash flow in the 3 categories because here there are 5, but the first 3 are very similar to the cash flow. What are those 5 categories? Operating, investing, financing. So those are the ones that you see in a regular cash flow statement. You have income tax and discontinued operations. So that's the major change. Okay, so this one significantly, this change alone is significant. Okay, but the headline change, the most important change is the management performance measures, or what we call as MPM. And I've included an example here, which I'm gonna go through it. So what are the MPMs? So مثل ما حكينا بالأول, IFRS continues to evolve to be able to bulletproof and protect all the involved stakeholders. We're talking about employees, we're talking about shareholders, clients, suppliers, and banks. So all the involved stakeholders are very interested in the application of rigorous IFRS or standards. So as I mentioned, P&L is structured into 5 defined categories: management performance measures or MPMs must be disclosed and reconciled. So previously or this year, up to this year, you can mention anything about those NPMs. You did not have to reconcile them. Now. When you mention them, you are obliged to reconcile them. So it's becoming more difficult to bury او نحط تحت السجاده الون اوف items. Okay, so any one offs يلي هن منهم regular. By one offs we mean not regular operating costs are very difficult nowadays to be hidden or with IFRS 18, and it's now the P&L is more structured and can be read better by the audience. Okay, I'm gonna go to the example that I mentioned regarding the management performance measures. But before I go this, a quick brief on the 5 categories. So operating, it's the core revenue and costs. So core revenue, direct costs related to operation, and even indirect costs, but those are strictly operating. So let's say we're selling a product, the direct cost would be the cost of goods sold, and the indirect costs, which will still show under this category, would be the employees, would be the rent, so anything with operational aspect. Investing, those would be strictly related to either income or costs coming from investing items. So bank interest, received bank interest or paid bank interest. This is the quickest example. Financing. So financing, we're talking about cost of debt. Sorry, I switched them. So I was talking about the financing part. For the investing part, it's any return that comes from investment. But what do I mean here by investment? Anything that's outside my regular operating activity. So let's say I run a supermarket, that's my core business. However, at the same time, I own properties which I just rent for extra income. This would be, again, an investing activity, not an operating activity. So that's in terms of P&L. In terms of management performance measures, I'm going to give one simple example because the complexity is far more than this. So usually companies come and say adjusted EBITDA. So usually we have EBITDA, earnings before interest, tax, depreciation, and amortization. But companies usually use the term adjusted to try and remove any one-offs nature expenses. So this one we disclose, or we mentioned that it's 2.1 million. So my adjusted EBITDA is 2.1 million. I need to reconcile it, as I mentioned, okay, to the operating profit. I should show that there is the depreciation of 0.4 million and the one-offs that I just mentioned you. Those one-offs, what could be those one-offs? It could be a huge legal case that I either lost or won, and it has impacted my EBITDA. Hence, I use the word adjusted EBITDA and I remove from it the cost or the income from this one-off. And I arrive to the IFRS operating profit of 1.5 million. This is the kind of reconciliation that must be disclosed, and it didn't used to be up until today, until the end of 2026. Now, to wrap up, before I try to go and pick some of the questions or the chats, every standard we covered tonight or this afternoon is not just an accounting treatment. So I try to focus a lot on this angle. It is a trigger for a business conversation. We need to have the conversation, ladies and gents. Okay, that only us finance can initiate. Because why? Why? Because us finance, because only us will understand and we know the numbers. Okay, we saw or we went through IFRS 15. Are you in the room when sales are structuring deals? If you're not, you should be. Okay, so raise your hand and ask to be. Okay, IFRS 9, are you sharing an ECL matrix with your CFO every month? Yes, the ECL is updated every month. If not, the CFO and the management, they are flying blind on credit risk. Okay, I have to say it. They are flying blind on credit risk. Third one, IFRS 16. So are you modeling the lease versus buy model that we discussed, and what's the impact? Okay, so again, you should be on the discussion whenever there are leases with substantial values, of course. IAS 36. Are you flagging impairment risk in monthly reporting? or leaving it just up until year end. IAS 37, are your warranties and legal provisions assumptions feeding into product pricing? So remember, when we talked about provisions, this is an extra cost, and you should include it in your pricing while you are pricing your product or your service. You see, again, those aspects are all strategic, and it's no longer about a comprehensive IFRS. It's about having the conversation and the analytical and strategic mindset. IFRS 13, are you stress testing your fair value? So we spoke, or we went through the IFRS 13 fair value. And last but not least, IFRS 18, are you preparing your MPM's reconciliation framework for 2027? It needs a lot of preparation, of course, for those who want to adopt it. I want you just to go out from here with one action. I want you to pick one of these standards and ask yourself honestly, is your finance team or the finance team in your company or you are doing this today? If not, this is your opportunity, okay? This is how you move from management accountant to finance business partner. And again, you open the eye of the management on a lot of things. And I do know for the fact that a lot of companies do not apply or just ignore those standards. And that was me. I'm gonna look.
Fantastic, fantastic insights, Khattar. Love it, love it. Thank you so much. As you mentioned earlier, we're gonna take a little bit of time to answer a few questions, but I'm gonna give you a couple of seconds to take a breath. Thank you so much for all that. And I honestly, personally love the term that you referred to multiple times during this presentation, business partner. So it's about having a place at the table, because as I mentioned in the beginning in the introduction, and now you emphasized on that, finance professionals, accountants are no longer bookkeepers. They are someone who is integral in the business decision making process. So the term business partner is very commonly used amongst diploma IFRS holders, CPAs and CMAs nowadays. So all certifications are now designed to allow finance professionals and accountants in particular to not only be those number experts, they are turning into someone who has, I would say, the most holistic overview and insight into any company, irrespective of its field. They can look at the numbers from marketing, sales, operations, acquisitions, loans, whatever it is. They can put these numbers together and actually tell the story. Every figure has tons to say. And moving forward with all the hype on AI, generative technology, and all that jazz, a lot of people are now feeling somewhat replaceable, perhaps, but the people who can actually make sense of all these numbers and truly create a foundation for proper decision making are those people that will never be replaceable by an AI or any type of technology. So thank you for all those insights, Khattar. And if we're going to answer a few questions, we have a quick maybe question related to the default rate. When you mentioned about defaulting in the second IAS, I think, if I'm not mistaken, someone asked, how do you identify a default rate?
Okay, I think this falls under. Thank you so much for what you just mentioned. It's really spot on. And let's face it, the finance people, the mature ones, and the business partners always will have a seat at the table. They will be the right hand of the CEO, and this is a great opportunity from a career progression. Okay, especially if you really like finance. By the way, you would also have the skill of reading the financial statements, and why not invest in the stock market? So if you look at Apple, at Microsoft, you can understand the dynamics and you can build your decision to start and invest in those.
Yep.
Just to answer your question on IAS 37, the default rate is, again, we said that you have a certain product that you have been selling for the past 10 years. On year one, you sold and you did not know that you're going to have 10 out of the 100 items you sold that are going to be
Defective, maybe.
defaulted or defected. Yeah, that's the right word, defected. So this is a 10% that you should account for moving forward. Next year, you became aware of this, right? Or next year, you consistently also had 10% of defected items. On year 3, you would come and say, hold on a minute. Or the finance should come and say, hold on a minute, Mr. X or Mr. CEO, our items are selling with a default rate of 10% or 5%. I would like to book a provision for those and build it in the price because I should charge it to the customers at the end of the day. I should charge it to the portfolio of my customers. I should not incur the cost if I want to maintain my margins.
True.
It's judgmental, however, it's based on a historical rate.
Nice, nice. And in the same topic, when we're talking about provisioning, there was also the question of, depending maybe on the type of expense or whatever it is we're provisioning, is there a particular or specific timeline that we should provision for? So you mentioned that provisions should be accounted for at the end of the first year, reconciled maybe, or recalculated the second year. Should we hold them for 3 years, for 5 years, for 10 years, for as long as the product is valid, or is there simply a legal timeline that we should abide by?
That's a very good question. Okay, so we said there are 3 conditions. So first of all, there should be a present obligation. Okay, so لازم يكون عندي كلفة أنا عارف إنه بدي أدفعها. It should come from a past event, so probable obligation, and it should come, sorry, present obligation. Okay, and it's coming from a past event وحتكلفني هيكون في عندي cash outflow مني. All right. What I can do here again, we said, is that we can use a reliable estimate, or مثل ما حكينا على الاكزامبل تبع الديفولت ريت تبع الورنتي provision. However, no, we cannot leave those to the end of the year. We have to account for those as we go, right? So those should be either booked or released. What I mean by released انه في حال عرفنا انه there is no present obligation وما راح ادفع مصاري, I cannot at all leave them to the coming year. So I cannot leave them at all to the coming year. I should release them in this year because, again, the accounting, one of the first principles also under IFRS is the matching principle. So the revenues related to a year should also be matched by the cost for the same year.
All right. All right. And one last question. When we were looking at companies that may be defaulting, that we should assess ahead of time and realize that ahead of time as well.
Okay. Yeah.
There was also the question of, how do you define the ratio by which that company is defaulting or depreciating?
That's a very good question, and I think this is what you meant in your first one. I'm sorry, but again,
I'm not sure. Could be.
we
I'm just
exhausted.
answering the questions.
Yeah, that's okay. No, I'm sorry for the one who questioned the question. Okay, so in terms of assigning the expected credit loss, that's really challenging because I face it. Okay, so what I eventually end up doing in all my markets, so Saudi Arabia, UAE, Lebanon, and the countries that we are present in, Turkey, you should basically, the best thing to do is that look backward and check what you have been writing off from those debts and understand what's the percentage of write-offs for those windows. However, we know very well that the businesses here in the region avoid and do not like writing off. Hence, there could not be a proper or strong history. Here, the business should make its own judgment. They should talk with their credit controllers, try to understand from them. Let's say I am a portfolio business. Okay, I sell schools, I sell hotels, I sell commercial business, I sell residential. For each one, I need to understand the dynamics. It's not an easy exercise, by the way, and I could speak and speak and speak until for more hours. But this is the concept. So either you rely on your historical write-offs, if there is one solid, or you have to make a certain judgment and estimate, and you have to sell it also to the auditor. That's the more difficult part.
So again, it's all about data, interpreting it, and making sense of it. Beautiful.
Absolutely.
Beautiful. Thank you so much, Khattar. There was a hand raised by Ajad. So Jad, if your question hasn't been answered, please feel free to unmute and ask it, or simply post it in the chat. In the meantime, Khattar, I want to say thank you from the heart for this information. I know I personally valued it a lot. I'm pretty sure our candidates are happy. I can see a lot of reactions, a lot of thank yous in the chat. So thank you so much for that. Thank you so much for the time. I know you're already traveling. So again, it was very, appreciated for you to make the time to be with us on this one. For everyone asking, we will be sharing with you guys within 2 or 3 days the recording of this lecture. So everything you saw today and heard, you will have access to review and revisit for a while. And thank you, Benoit. All right. Thank you as well. So again, we hope to be available for you guys again with such insightful sessions with Mr. Khattar and other Morgan faculties as well. Hope you enjoyed it. Looking forward to servicing you again very, very, very soon.
Thank you, everyone, and thank you, Charles. Have a good evening.
Bye bye.
Bye bye.